Coming up on today's episode.
So many scenarios. So I love that you kind of saw that you were good at something, you enjoyed it. Why not actually just go into it? Give this to your uncle. Look at what he's produced.
Oh, thanks, Uncle.
Yeah, thanks, mate.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together.
I'm Daniel Demirci, and I'm a tax accountant. We're going to be talking a little bit about tax, property, and growth. Let's go down and have a chat.
Welcome back, everyone, to the No BS Real Estate Podcast. You're listening to how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, today's episode is for anyone in the growth phase of their journey. Maybe you're a property investor who's built a foundation and wants to scale, or you're a business owner who's finally moved past survival mode and is ready to set things up properly for the future. By the end of this chat, you'll walk away with a clearer idea of the stepping stones to build wealth and scale up successfully, and why the right accountant can be the difference between spinning your wheels and building long-term success. My guest today is Daniel Demirci, Director at Daniel & Co. Daniel specialises in helping clients put the right structures and strategies in place during their growth phase, from property investors building portfolios to business owners looking at smarter tax planning, debt management, and even tools like SMSFs. And fun fact, Daniel and I actually went to high school together, and he was the year above me. So this is a bit of a reunion as well as a roadmap to success. So Daniel, welcome to the show.
Thank you very much. Thanks for having me. It's good to see you again.
I know.
After all these years.
You haven't changed. Like, literally the look, when you walked in, like, yeah, it's Daniel.
Haven't changed since I was 17.
No, you look the same. You look great.
Thank you.
I was going to say, what's funny, like full circle, just to segue for a moment, I worked with your sister, of all people. Like,
you did.
It's so weird to have it like come all the way back around.
I know. It's funny how the world works.
I don't get it. Like, it's just, there was no reason, right? I remember she goes, I went to high school with you. And I'm like, you did too. You were younger than me.
Yeah.
And because I remember, we were at senior campus together because you're 12, I was year 11. And I remember that vividly, but I didn't really get to interact with your sister much at school. But what was a lot of fun was to reunite with her. And I'm like, how's that going? And she's like, yeah, good. And then you're like, oh, we reached out, we spoke. And I'm like, all right, there's actually a place for you to come on the podcast. We need you. Let's have a chat.
Yeah, 1 minute you're working with her and the next minute you're talking to me. So
it's a family reunion. It's a high school reunion. Like, no, that's not the show we're doing today. But I think like all good places to start, Daniel. One, thank you for being here. It's so good to reconnect. I think we've got to go into your journey. Talk me through how you first got into accounting, like straight out of school, basically.
Accounting for me, I guess, stems from the family itself. Well, my uncle's an accountant, has been an accountant for about 30 to 40 years now. And he's got his own practice and he's been operating out of Abodey for most of that time. And now during high school, when it was time for VCE, we were trying to obviously think about what sort of direction we want to take. He was one of the guiding mentors at the time in terms of explaining to me what accounting, tax, and how the actual career looked like and what's involved and what sort of things you need to do in order to, become a good accountant and a pathway to get there. Yeah, we had a bit of a sit down when it was, during VCE and he explained to me exactly the way you get into it. And he actually told me, it's good for you to make your own mark and work for some firms, and then eventually who knows what will happen in the future. That's how it all started. And just a little bit about myself is I've really had a lot of interest in business, legal side of things, and they're all the subjects that I did study at during school. Putting it all together, exactly. That's exactly why just tax, law combined in business just makes an accountant. So that's how it all started.
I love that. And, I haven't heard someone describe accounting in that way, but you're so right, because all the things you have to be across, it's like, it's not just managing a budget. It's like, no, there's compliance, there's tax, there's so many scenarios. So I love that you kind of saw that you were good at something, you enjoyed it. Why not actually just go into it? Give this to your uncle. Look at what he's produced.
Oh, thanks, Uncle.
Yeah, thanks, mate. And, you worked across, then moving forward into, you've obviously gotten into the field, you studied for a while and, you've worked across both small firms and big ones. But I guess, what did you take, like, what was your takeaway from those experiences from those early years?
Really asking the questions. So whoever, who's mentoring you or guiding you, your managers, you have to ask the questions. If you don't understand something, you need to ask and not be worried about what people are going to assume, because at the end of the day, everyone starts somewhere, everyone's there to learn, and the only way you're going to get better is by asking those questions, doing your own research, try and develop yourself externally to work as well by doing classes, taking up different types of accreditation, like doing your CPA, doing your CA, the types of credentials which are invaluable to you, over the life of your career. So those are the sorts of things that you really need, and you really need to start doing when you first start in a career accounting.
Yeah. So it's like those really foundational things. It's like get every feather in your hat that you can to do a good job.
Exactly.
And it makes sense. And I guess, those firms that you worked for, like small and big, like it all adds to your experience, right? And shapes how you kind of forge your own path into accounting, which kind of makes me, go down to the next thing, which is like, at what point was there a moment, or at what point did you decide to start building your own client base, and what was that process like?
So that probably happened about 2 to 3 years ago, where, I was looking into starting my own practice and also, trying to build up a client base. Now, to do that, obviously, you've got to go out, network, try and build up enough leads and trust within the community to be able to have them come to you to your advice. So this took a little bit of time to do over time, and naturally, slowly, there was a snowball effect, and more clients started to come on board. And then soon enough, there was enough clients there for myself and my uncle to come together and work together and do a whole trajectory of, working from starting out somewhere else and then working back.
Because this is the same person that all those years back, was guiding you and giving you that mentorship at such a young age. That's so cool that like all those years of like your uncle kind of mentoring you at that young age and like that circle, you're able to kind of come back to him and go, okay, I think I'm established enough to add value to the business that you've built. And that's a huge amount. I think he would be very proud.
Yes, I think so.
Yeah,
I think so. And it takes time, and he was obviously patient as well, trying to see how I was progressing over the years. Now, this is about a 10 to 12 year journey that it took before I got to this position. And, after all the effort and struggles, it was all worth it.
Yeah. And this is part of why I want to do on the show, right? Because I think what we're going to unpack today is super important, and all those years of experience, like, come to this. You're very passionate about educating people.
I think it's because that across the board, there is a certain lack of unfamiliarity with building financial acumen across Australia. Now, that's one thing myself spending a lot of years doing, is I like to give back and try and educate people in terms of how they can actually manage their finances. Finance, at the end of the day, is for everybody, because everybody has to deal with it. Everybody leaves school and they need to buy properties. They want to invest. They want to save money. They want to do all those things. And so through education, being able to get them to understand the implications of the choices that they make is essentially what we are here for, try and lead them down a path where it's going to be beneficial for them financially.
Yeah, I think you've said that so well, because you can't escape finance. No matter if you're someone who doesn't have savings and maybe you love Netflix and, all the subscriptions, or maybe you're someone who loves holidays, or you want to start a business, or you want to go down the property investing route. Like, these are all things that impact your daily life, and making wrong investments or bad investments, depending on how big they are, could be very bad. Without the right guidance and advice. So
Exactly.
It makes sense. And when we were talking in our podcast interview, this is something like Daniel and I ended up on the phone, and we weren't just catching up about high school guys. Like, this is like legitimately, we were catching up for like 2 hours talking about educating people about good finances, real estate, property investing. We went through so many topics, so many angles of what we wanted to talk to you guys about today. And literally, like, we're going to have Daniel back on the show because we just had too many topics. I think there was easily 6 topics we covered in that 2 hours.
Yeah. It could have taken the whole afternoon, but we thought, we've got to get back to work.
It's like we got to do something other than podcasting. But so we're going to, there's so much value that's going to be unpacked in the next few episodes to come with Daniel. And I think this one today is super important to set the foundations, right? So they have like a small SME or a sole trader business. From your perspective, what does the growth phase actually look like financially?
The inception phase consists of you deciding what sort of structure and formation that you want to use in terms of building this business. And then the growth phase is where you start building a trajectory into the next phase, which is maturing, where you build up a mature business. Now, within the growth phase, there's a lot of things that happen. Now, in saying that, with your profits, usually in the growth phase, they start to be reinvested back into the business to start to scale even more. Now, that includes increasing your labour costs, increasing costs for technology to try and build up those scalable systems.
Yeah, and I think that's really nicely defined because, yeah, everyone thinks that that startup phase is, this is growth for me. It's like we're talking about a different type of growth in today's episode, and it's really about that. I think you said it so well, like the turbulence through growth phases is very real and very stressful for a lot of people, whether it's, they want to sell that first investment property or they want to add investment properties and grow that. Both scenarios in this episode today. But the business one is really for the guys that have submitted. Thank you everyone for submitting questions around the business stuff because we get a lot of inquiries about it. Saying, what about business? Do you cover business? This is, I'm proud to say, one of the first episodes where we're going to talk about it. So as someone who's moved past that survival mode and into the growth phase, because you've experienced this yourself, through your uncle's business, your own business, what's the very first stepping stone that you usually look at with your clients?
In terms of a stepping stone, what we look at firstly is to see, are they structured correctly? Now, that's the first thing that should be done and should be discussed before actually commencing operating a business. Now, you should discuss this with your financial professional, your accountant, your solicitor. They're the ones that are going to explain to you what the disadvantages and the advantages of that particular structure is. So amongst all that, you have to see what your goals are. You have to work out what your strategic objectives are and work backwards from there. So through that, we have to say, well, what's your family goals and expectations? What are your personal goals? What are your business goals? Once we work all those things out, that's the first stepping stone to realizing exactly how we're going to get to that next phase. And by putting your systems in place to get there.
That's super important. Like, it's actually making me reflect on some accountants I've had, like in those very first early years, like I'm talking years ago, and some of the situations of bad structuring at the start and having to change. Like, what are some of the tools or financial instruments that they should be aware of? Is there anything from a property investment perspective that they need to be thinking about?
So they can use different types of reports. So you've got, property growth reports within suburbs that you can access online. Abodey obviously has, that's definitely a financial instrument and a tool that people can use. There's also other ones as well that can. The other thing would be type of calculators that you could, servicing calculators, profitability calculators on properties, where you can put in the type of property that you'd like to purchase, and you can categorize things in certain ways and forecast the type of profits that you potentially may make over a certain amount of time. Now, there are ways of trying to work out to see if this is a type of property that you really want to invest in, and also to understand the nature of where property is located. Is it going to serve your purpose? And also to work out to see if you actually have the funds or serviceability to be able to purchase this property. Is it going to put you in financial hardship or not? They're the questions that people have to ask. And looking at the financial overview of somebody, what we try and do anyway is we'll look to see, what their living expenses are and to see if they actually have the funds there to be able to. There are different types of tools, and it's best that people utilize and access them, and also access this type of information through financial professionals as well.
That's what I was going to say, because obviously property is usually like maybe someone's got a buyer's advocate or maybe they're doing it on their own. And a lot of the time what I find is as a finance professional, you end up being the real estate psychologist when they don't want to use a buyer's advocate. They end up having to say, so what should I buy? How much should I offer? And you're like, it's not my department.
Yeah, exactly.
But, obviously you deal so much in terms of value and growth. So what is that clear distinction? Like you're setting up that roadmap for them really about what type of asset they need to buy, or is that kind of how it works in the sense of like I'm trying to picture someone listening who's thinking, okay, so I've earned the accountant for the affordability piece and for the money maker.
That's how we would actually link the client up with the buyer's advocate to make sure that they buy that particular property that's obviously suited to them. We'll let the buyer's advocate know exactly the type of client they are, what the situation, make sure that, hey, this is going to be best suited for the client, and then they'll go ahead and purchase it in the relevant type of entity that we see fit.
That's awesome, because I think that's something that a lot of people miss out on is they put the pressure on finding the asset themselves. And do you ever run into that kind of situation where you have to sometimes tell clients, go, no?
Yeah, very much so. Like the thing is, when people are going out to buy property, a lot of the times they're quite lost in what they want. They don't know exactly the type of property, where to buy. They don't have the information or don't know where to source the information. So this is where there needs to be a way to collate all that information together, which I know is what you do. And this is how clients need to access these things to be able to make these type of strategic decisions. These decisions are the biggest decisions they'll ever make for their family.
Investment can just really hinder. It's not undoable, of course, like everything can just be worked out, but it might mean that we get a little bit in 2 years to get all this growth and it hasn't happened, and now that's an investment you have to keep.
Exactly. There's many apartments in Melbourne that have been in that scenario where people are purchasing through different types of entity structures, and over time they've just seen a decline in value.
I've got the perfect example of that. I had a client that, this is a couple of years ago, I was doing my due diligence, and there was an apartment they found. It was an owner-occupier. They said, they wanted to live there, a young couple, and I said, I don't advise on it. So what happens is goals like, do you have a family? What are you going to do? If this doesn't make the money, and this is going to stop you from having a family. If you wanted to start having kids, and if the answer to that is yes, then this is probably not the right home, even though you're thinking to start a home and that's the budget. What was interesting is when I did my due diligence and I was able to turn it around, they got into an actual a unit, which was going to have a really good return. They made a lot of sales history on that, sold at the same price every year, and like not even the same price. It was like maybe 5, but consistently from 2000 and I think it was 2010 was the first sale at 505,000. The next year, it sold again, so it had a lot of turnover, had 8 turnovers, all averaging between 505 to 2025 this year. It did sell in the end, and again, sold for $5,000 less than what they bought for.
It just goes to show, like, people are trying to get rid of that type of stock, but it's always readily available. But people need a place to live. That's one thing. But there's the other issue of apartments is now the land tax. That people are also, when they try and buy this through an investment, they decide, well, this is a good one, but now you're slapped with a minimum rate of land tax, and they've just captured every single person. And that's the issue as well, where you've got people going out there looking for properties, but they're not sizable enough. They're not sizable enough for what they want, and they're living in these really small, 30, 40 square apartments, and they grow out of them very quickly. So the turnover is quite quick. So the issue is that the price of houses are just phenomenally going up way higher than what the wages growth is going up by. So,
it's a big problem.
Yeah.
Especially for a lot of our listeners, like this affects everyone, right? Sometimes like that's the only type of asset that may be the sake of buying it.
Yeah.
Like that would be red vesting.
Exactly.
Buying, in a very far away place. It could just be where to go, like Bendigo. It's like a lot of people don't necessarily live in Bendigo because maybe your work's, in the eastern suburbs or in the southeastern suburbs, or, living in Bendigo is not practical, but the budget suits you.
Yeah.
And the budget lets you enter the market. You could do something like Redfest. So this is the type of structure, and is that the kind of stuff you also go through with your clients?
Definitely. So we'll look to see what's going to be the best means of entering the property market. A lot of people want to do that, especially now that the market's starting to heat up. They want to either get in there now, if they haven't already, or see what else they can do with their funds. Are they releasing equity to purchase other types of properties? Are they selling properties? They're all the questions that people are now asking us.
Yeah.
To find out, to see what is the best case for them and their families at the moment. We'll discuss in great detail as to how we should go about structuring this, deciding what sort of avenue to take, and then at that point in time, that's when the clients see it.
Yeah, and then make that choice, and that's where you're helping them, actually have clear eyes before they do it. It's like, help us buy this apartment, should be right.
Yeah, that's right.
And I want to switch gears a little bit. Like let's talk about someone who's moved past that survival mode, that startup phase where they've maybe bought that and they're ready to grow. For business owners, switching gears to them, what's the structural strategies that make the biggest difference when they're scaling up?
So implementing systems firstly, to be able to make sure that you've got enough systems in place to be able to take a little bit of a step back and delegate that sort of work across the entire business. Firstly, you want to have technology in place. If you need the staffing resources. Is there a sufficient amount of cash reserves available? And is there enough funds coming in to be able to pay for these labour resources as well? So a lot of these questions are asked and posed to us. And we always have to sit down probably every 6 months when they decide to try and take their business to the next level, but they may not be ready. So what we look at is to see when they're at that growth phase, and we can definitely see that they're there, then that's when we'll try and manage that process with them. Their pricing may be another thing that we discuss with them. They may have underpriced at the time when they were in the inception phase, but now when they're in growth phase, with materials and cost of sales, they've been increasing as well. So they want to start increasing these profit margins by reviewing all these things together.
I think that makes so much sense. As someone who's also in the growth phase of their business, right? This has been sort of we have more demand resources, and we're running those structures, like you mentioned, is so important. I don't think a lot of SMEs, especially for those of you listening, a lot of you have that emailed this week. There was one particular guy, Tom. Thank you for emailing. He mentioned he's got a small business. It's a small retail shop, and he's like, it's growing and growing and growing, but my costs are going up and up. And he said, I don't want to take a second mortgage out of my property, my business. He said, I'm going to go unsecured, but he can't go unsecured because the profit and loss margins don't add up.
Yes.
And this is the trap. He's like, what do I do? What's my next step here? And I've gone, I've got a guest for you. You probably need to talk to him.
Yes.
What do you say to someone who's kind of in that position where their hands are almost tied a little bit, or maybe their risk appetite isn't exactly where it would be?
Well, when we look at the situation as to how they're currently formed, the way that they've been operating, we'll look at it and discuss. There was actually, funny enough, another person that I was speaking to about a month ago, and they were also in retail, operating as a sole trader business. With that comes there's unlimited liability there, which means that if something was to happen to that business owner, if there was, for instance, some lawsuit, well, unfortunately, they've got all their personal assets on the line. So when we look to restructure those things, we explain to them what the advantages are of restructuring. There are tax implications as well at structuring those things. So, by forming a company or forming a trust, there are different types of entities that we do form for tax minimisation purposes, for asset protection purposes as well, and also for income streaming purposes. You have to look to see how the family is formed and what ways we can utilise the actual structure to minimise tax, protect all their assets, and to be able to scale and grow. Now, when you're a sole trader, there's going to be a certain time that comes when you're going to start paying top marginal tax rates. So, for instance, like your person that you're discussing it with, once they hit top marginal tax bracket, they'll be at 47% tax brackets.
Yeah, so I like the way you answered that. Thank you. This leads so perfectly into another instrument like SMSFs. It gets talked about a lot. And For those that don't know what I'm speaking, they'll be self-managed super funds is what we're talking about. So it's not having the super with one of the big, companies that maybe you probably fell into when you had your first job at KFC. And then that's the super company you kept for the last 15, 30 years.
Go with the default fund.
That's it. It's like just default fund. And you've just never changed because that's what your job told you to do. And typically that's how people fall into, super funds, right? Without going too deep, like where does an SMSF fit into that part of the growth journey? When does it make sense for, a business or, someone who wants to do property investment to look at that as a viable option?
Self-managed super funds, especially what they are is they're a way to utilize the funds that you've got already in your super fund to be rolled from an industry super fund into your new self-managed super fund. And through your own discretion and advice through professionals, you're able to utilize the funds in there to invest accordingly the way you want to, and also the way you're instructed to by, say, a financial advisor. So this gives you flexibility to be able to invest in different types of investment vehicles. So you can invest in securities, equity, bonds, term deposits. They allow you to be able to diversify your funds within a self-managed super fund according to what that investment strategy entails within that self-managed super fund. An investment strategy usually gets drafted by an advisor, and they explain, based on your risk profile, this is how we see fit in terms of how you should be diversifying your... So what you can do within a self-managed super fund is purchase residential property. Income will then go into the self-managed super fund bank account, and it will just operate as like a normal residential investment property, but all through the self-managed super fund. Now, the benefit of that is it's in a low tax environment. The self-managed super fund is taxed at 15%. When there's contributions made into the fund, there's a 15% tax on those contributions made.
Yeah.
Now, you've also got the benefit of being able to contribute more depending on how much funds you've got, available in your hand. You can contribute more. You can also get a tax deduction for those contributions as well. So that is a vehicle for clients to be able to utilize to purchase property. Now, in order to purchase a property through a self-managed super fund, you can either do it holistically with all the cash that's in the actual fund, or you can borrow in the fund as well. You can borrow against it. So that's called a limited recourse borrowing arrangement, whereby you would actually go to the bank. Not all banks offer SMSF lending, but you'll go to a specific lender that allows for SMSF borrowing, and they will provide you with the necessary funding.
I think that makes sense. So is this why, in terms of what business doesn't feed into SMSF as much?
Yes. So business and SMSF, they're separate.
Yeah.
So you can utilize the business that you've got to also contribute money into your SMSF. So if you pay wages to your staff and yourself, I guess the wage that you pay to yourself as a director or a business owner, self-managed super fund, and thereby purchasing that property or whatever other investment you want through the self-managed super fund.
Yeah, gotcha. So that's kind of feeding the SMSF to allow you to then do other activities to fund your retirement or whatever it is.
Yeah, exactly.
No, I love that. Very well answered. And I think that's probably the cleanest way I've had someone explain it. So, and I think if someone only was to take away one thing from this chat, what's the most overlooked starting point that can set them up for long-term success?
The most overlooked part that a client...
Go. Yeah.
Take two.
So I guess if someone only takes one thing away from this chat, what's the most overlooked starting point that can really set them up for long-term success?
The most overlooked starting point would be, firstly, to contact your professional.
My God. All right, let's do it one more time. Three times lucky. What's it? Third time's the charm.
I've got to think about that question.
Yeah, I think. You're going to come back to it?
Yeah, I'll just... So the question was...
So it's like if someone was to take away one thing, like what's the most overlooked starting point that can set them up to long-term success? But I think you're right in what you're about to say about talking to the professional because, to be honest, people don't do it.
Yeah.
So it's like, I don't think that's a bad answer. I actually think that's the most overlooked. Everyone talks about financial success. It's like, I'm going to go on Google and I'm going to get a spreadsheet on Excel and I'll get started. It's like, no, mate, just pick up the phone.
Yeah, exactly. Okay, we'll go.
Yeah?
Yeah.
All right.
Okay. Take 3 in 5, 4, 3.
So if someone only takes one thing away from this chat, what's the most overlooked starting point that can really set them up for long-term success?
Don't go ahead and do it all yourself. Speak to somebody, speak to a professional that understands what they're doing so that they can make sure that they structure you in a way that is best for you and also to allow you to be able to achieve those financial goals.
Starting people are so hesitant about reaching out.
Exactly. Just give us a call and, we can we're happy to have a chat with you. Make sure. Yeah, exactly. It doesn't cost a cent.
These days, one of them cost you $1.
No.
on the old dollar.
Exactly.
And I think this is the perfect place to talk about, customer experience and education. Like, I guess, those people, like you said, the most underrated thing is not calling. I have so many people in that position. Stop this up. People call ages ago that have been embarrassed. What are some of the most common fears or pain points that clients bring to you when they first sit down for this discussion?
A lot of the pain points that clients have at the moment, they're finding cash flow is a major issue for them. Whether that's be disposable income that they've got personally or cash flow within their businesses that they have. Now, a lot of the pain points they are finding as well is that the reason for these cash flow issues is credit terms that they've currently got with their suppliers and also with their debtors, with their customers. So there's a lagging effect with the way the money is moving. So they may have times where they've got they're also having to pay their suppliers in a much shorter time frame. And so the money is actually moving around to the supplier before they can receive any money. And so the flow of income is jeopardized. And so that's one type of issue that we see. The other type of issue that we see is the type of price that they start charging for their services. So we see that sometimes to get the job initially in the inception phase, they decide to sometimes beat the competition. That is a decent starting point. But what that does is that also jeopardizes where you sit in the market. Now, if you're sitting in the market at the lower end, the type of clients that you're going to be getting is you need to put yourself in a band where you see that this is going to allow for decent amount of growth over the next 24, 48 months, and then constantly reviews, being able to discuss these things and have these discussions about how we can actually utilize what we've currently got in place within the business to get to that next phase.
So I think one of the things that stands out is the product structuring. And I see this with, I've gone through this, but also I've got so many mates that have to have their own startups right in those communities. And the one discussion that we're always having is the pricing and the product. Like, how do you price this? We do our cost analysis, we do how much does it cost us to, make this thing and how much you're right. In the startup phase, it is like, we need traction. So just, drop the box and go with it. But your clients are not the right clientele that ideally then have been that long. I see this a lot happening. How involved do accountants get in that product restructuring side of things, or is it just mainly about the finances and the flow of that profit and loss?
So we'll access what they've got within the systems that we provided. For instance, most of our clients are using Xero at the moment, so we'll look to see what products they're currently being sold within the businesses, the inventory, the type of stock that's being turned over. So we'll look to see how they're priced and how that's causing issues within their cash flow and also their gross profit margins. So by looking at these things holistically and discussing those things, that's where we'll be able to manage the actual turnover that they'll be able to generate. We'll be able to forecast these things and also to leverage those systems that we put in place to be able to make better decisions.
Yeah, and I guess, can you share a story about helping a client who was maybe struggling and you helped them not just survive, but actually set themselves up to grow again, like then for the pen to in a happier position in the starting?
Yeah, we've had, I had spent a lot of money on assets that weren't generating any income for. Couldn't afford it. All the fun stuff. And they came to us asking, I don't have any money. I'm not turning over much. What's going on? Should I even have this business running at all? And so we sit down with them and we look at what they're currently spending day to day. This is things that are outside the business. We'll look at all that and we'll say, you've got no money at all because of the habits that you build in. And it's all a mindset thing. This is one of the things that we try and instill into our clients is the mindset and how to change those to be able to get to where you need to get to. So these are spending habits that you may have. All these types of things where that may jeopardize the financial outcome for the client and also the type of lifestyle that they want to live. So if we see that they're spending far too much money, they're indebted heavily, it's because of the decisions that they've made. That's where we'll be there for them and allow them to understand why they're doing these things, what they need to do to change them, and certain decisions that need to be made now to change the situation. And then eventually what we'll see is the tax that will eventually be cleared over time. We'll see a change in profitability. We'll see that the growth of the business is starting to move and it's starting to pick up. And we'll also see that they've got more money in their pocket. And so the stress ends up getting more relieved. They come back to us, see different things, like they start to have the money now to pursue new properties. All of the good things in life, they're able to now do. Yeah, no.
Well, we can fix this.
Yeah, exactly.
And I think that's the power of like these discussions with, someone like you, is unlocking those things that you didn't even probably know, like habits built, because sometimes you don't even know you're doing like such a major reaction to whether it's like Uber or streaming services, like, going out for dinners or going out for lunches, like coffee. The biggest one that I had years ago, my stepdad, I was still living at home COVID, sometimes twice a day because I can't go out. So.
I was trying to get the Monopoly stickers. So I spent a good 2 years doing those things. Exactly. They didn't work. I never won nothing.
And so, no, did nothing but just give this coffee shop our money. Yeah. They were so nice. Like, they always wrote little personal messages on the coffee cups. My stepdad, like that, he just hit the roof. He goes, "How many frigging coffees?" And we're like, "Read about it." And like, we're not getting smalls. We're like large almond cappuccino. Like, it's all extra large. We spend like with the delivery fee and everything. It's probably like $20 because we had a habit of every single morning before work, like both her and I separately would go and buy coffee on the way to work. But the difference was I spent $5 and it's $12 a day. It's not great, but I spent $5. Whereas Uber Eats, Jesus, like, he hit the room and he's like, "It's not because we don't have the money, it's stupid money." He says, "We have a coffee machine at home."
There are these small habits that make a big difference in terms of how you got the money there and how you got funds to do other things in life.
Yeah, it's so true. And like when I think back, like $20 a day every day. Not even just birthdays. We bobbed it on Saturday and Sunday.
Oh, of course.
All right, so 7 days a week. And pretty much for the whole of lockdown, we did that. It was a long time. It was locked down for a few months. Like, I had money racked up. I probably could have bought another house. It's like, it's only like a cup of coffee, but I could have done a lot.
Wow.
So this is what I'm saying, like, to you guys who are tuning in. This is like the power of discussions where this story that Daniel just shared, it makes sense. It's like someone's in a position of dire straits and they don't think they're going to make it out or they can't change their life, but it's these small habits that you've got to keep. And I totally resonate because
someone's got to tell them.
My stepdad was the Nazi. He just walked in the machine. Like, "Absolutely, I'm stopping this shit." Yes, you've got a coffee machine, you can have barista coffee.
That's what I've done now.
Yeah, well, I do it now. Ever since then, ever since he backed out, I was like, okay, I need a coffee machine at my house now. I'll do it with my partner. We do have a coffee machine, and every day I'm making espressos, and I'm very happy. And I would never dream of buying coffee.
No.
Very rare do I buy coffee these days. And that's so weird to me because that habit was like...
Yes. Well, look, I guess these are the types of decisions you've just got to make, and it will save you in the long run.
From one coffee aid to another, whoever's listening can do it.
You can. Just buy a coffee machine, decent one.
Decent one, with a longie, whatever it is. You'll be right. One of the things like that you said, like finance isn't just about the numbers. You said it right before you said it. It's about mindset. This is a big thing. What are some of the mindset shifts that you had to coach your clients through? Like, what have you seen?
Getting out of the notion of being an operator of the business and starting to be a delegator over, starting to sit back and thinking of yourself as, how do I get my business to a point where it's a well-oiled machine that can start operating on its own? What do I need to do to get to that point? People want to work less. They want to work less harder than they have already.
Yeah.
So they need to step back and they need to holistically look at these things and say, well, I'm spending far too much time in this side of the business. I'm spending far too much time in the admin side of the business, or I'm looking at things the wrong way. How do I change this? How do I look at things in a different way that I need to look at it? And so this is the type of discussions we'll have with our clients for them to be able to make changes.
Someone that is probably going from business owner to CEO.
Correct.
Mindset. It's like CEO can be, sitting here doing X, Y, Z. Like we need to shift that mindset into thinking of who you want to become.
That's right. That's right. Envision what you want to be.
Yeah.
Making the necessary steps to get there. You have to work hard initially. It's the bottom line. But over time, you want to start looking at, well, what am I going to do? Is there going to be a long-term plan, a succession plan for what I do with this business at the end of the day? Am I going to be selling it, giving it as an inheritance to somebody else to take over? Somebody's just going to, there's a key man there. You got to look to see, how am I going to be able to take a step in the right direction for my business and being able to work to those goals.
I think that makes complete sense. And I love the way you've answered that because, one of the things that is so important in any business, like you said, it's that those structures, those steps. Like it's all about structuring. What I'm learning through this episode and this chat with you, that these discussions, first stage, early stage or business initiation is important to set up the right structures so then when the growth phase hits, it's much smoother as a transition. Is that what you could kind of say to your clients like that? It's just as important as the beginning, not just at the growth.
Correct. It has to be right from the start.
Yeah.
When you get your foundations right from the start, things will fall into place much easier.
Yeah. And I think that will resonate with a lot of people. It's like if you're thinking of starting a business, or thinking about buying property, that's why foundations, first discussions have to be at the beginning. Not at the end or not in the middle where it's mixing. I said, but like starting a business with the right structures, it's going to make a massive difference. Like I'm getting so much from this conversation already. You work alongside, like flipping gears to, switching gears, I should say. It's like I drive. Switching gears into property side of things, you also work alongside like the team, like we touched on buyers advocates before, but you also work with conveyancers, solicitors, buyers advocates. When someone's going to purchase a property, how important is it to be part of that bigger professional team, then you're supporting your clients?
So it's very important to have these group around the client. So what we've formed is we've got a team of solicitors, brokers, buyers advocates, conveyancers. They're the ones that are surrounding the client, guiding the client together, all of us, to get to where they need to get to. It's very important to have these discussions with the other person. So for instance, we'll have solicitors that'll contact us.
Yeah.
And, they might have a legal issue and they'll contact us about financial situation of the client. We'll discuss with them exactly, how, based on their scenario, what we're going to do to try and get this client, out of the situation that they're in and into a better situation. So we're always there around them to guide them, almost nursing them in a way. Because without all of us, they may not be able to have the means to be able to make these type of decisions. So we're always there, and that gives them the confidence as well to be able to do these types of things, to know that they can count on, to get the property settled, the broker to find the lending for them. The solicitor's always there for the legal aspect of their business or personally. They've got the accountants there as well, from a tax perspective or financial perspective. All these types of things, if they've got them together and they're all collaborating, then they won't have a problem. They'll actually that's a full holistic service that we receive.
That's so true. And that, like you said, they're all playing such an important role. Like as an, buyers advocate, I work with so many accountants, with brokers, all of them, because we all have a part to play.
Exactly.
And when you start working with the professions, like this is me talking to you directly, like it makes a big difference for a client because then they're not having to do the middleman. Accountant this.
Yes.
It's like when you've got a professional that's doing that to you, my humble advice or, tip, get rid of them. They should be talking direct. There should be no reason why these professionals don't work together. Like Daniel said, it's a team that nurses you to make sure that you're going to the finish line or you're getting to the end of the race with a gold medal, not, coming last to dying for water, you're falling there. That's not the position we want you to be in. It's like everyone's accountable to you. And, that's the inside, that most people never get until, I guess, they're in front of an accountant, right? So But I want to bring in our listener favourite segment now, which is we throw some real life comments your way, which is Reddit myth busting. So the whole purpose of this segment, it's a fan favourite. If you're new here, this is where we pull real questions and comments from the online feed and also through Reddit itself. They are raw, unfiltered things that buyers or investors or business owners and everyday Aussies are saying about money, property and finance. So I'll read out exactly how they're written, and then we'll get Daniel's take on what's really going on and how the accountant or how an accountant can help make sense of it. So Daniel, you up for the challenge?
Always up for a challenge.
All right, I love it. I've got 2 to throw your way. This first one. This comes from the Oz Property Chat, and shout out to one of our listeners, Sarah, for sending this one in. This Redditor says, I currently have 2 rental units and my own business with a small mortgage. Could sell both, pay off my loans, then buy a new place and rent out my current house, which would be positively geared. But I'm already in a high tax bracket. Is it stupid to have a positively geared rental and a large mortgage on the road? So how does accounting, or played out for us, play a role in a situation like this?
So there's a few implications of this choices that this person is going to make. Now, a few implications, firstly, of selling the properties, the investment properties, there's going to be possible capital gains tax. Now, when you purchase another property, there's going to be stamp duty to pay. Now, the other situation to that is that if you decide to sell both those properties, well, you may have the cash now to pay down that loan, but in the same instance, you've got a property that you currently live in that's got a main residence exemption entitlement that you can utilise. So what I would probably suggest would be to be selling those. And if you want, it depends also on what the client's needs are. Do they want to actually buy a bigger property? If that's the case. Now, from what I'm understanding is that they're looking to go into a new property, which I would assume would be a bigger property, and rent out the old one that they're living in. Firstly, what I would do would be I would sell that one that they've currently has the main residence exemption. If they're looking to buy a bigger property, move into the new one and keep the 2 residential properties, 2 investment properties there to utilise negative gearing situation that they've got because she's at the top margin of tax bracket.
Yeah, gotcha. I like that. Oh, very well, too.
Right.
I guess, oh man, you just nailed that one. Because honestly, I was going to get the follow-up question, but you even said the structure. You're like, this is how I don't do it. And I said that, it's not who's thinking of that. Thank you. We'll hear that. That kind of tip bit on this episode with thing as well. And I guess, what are the risks of not thinking this through properly from an accounting perspective? Like for this person, they've got their 2 rental units, like they're obviously, they're in a tough, they're in trying to make that decision. Right? Of like, oh, what do I do? This is what I'm thinking. When they're not thinking it through properly and like they take that risk, or what kind of the negative implications is that she follows her plan?
Well, if she follows her plan, she will be up for some tax to pay. Now, depending on how long she's held that property, if it's more than 12 months, they may be eligible for a 50% discount on that gain. But if she should be taxed on the full gain. Now, that's one implication. Secondly, to purchase another one, the stamp duty costs are quite significant. So by trying to utilise in terms of tax minimisation strategies like selling a property when it fits your main residence and having that to be tax-free, you've got the cash now to be able to buy something that's bigger, and you've still got the loans as well. So if you've got loans there against the properties, you've got a negative geared situation. And if that'll bring down some of your income, then you'll have a better tax outcome overall.
Yeah, well answered. And it's true. And then that's why you're saying the other way. It's like that big liability that she has with the...
Yeah.
So like, to think about that structure.
Yeah, exactly.
And this next one, this is another quick one. This one was submitted from, Reddit Buzz Property Chat as well. And it says, my old employer has offered me a contractor role with 20% more pay. We want to buy a property in the next year. Will banks look at contractor income differently? And how will this hurt our chances?
Well, banks will look at contract income differently to, say, full-time permanent employment or part-time permanent employment. They may shade out some of that contract income because there is a finite amount of time on that contract. So let's say they've got a 2-year contract. The banks know that at some point that's going to end. So they may shade that income. Whereas if you've got full-time income, then they know that the income is regularly continuing. And so they'll be more likely to lend more in terms of borrowing. So yes, you may be receiving 20% more to a contractor payment, but on the flip side, you may not have the income there in 2 years to service this loan.
Serviceability. So there's a certain security that comes with salary-based jobs.
Correct.
Right. And I guess what should someone consider before making that switch? Like if they've got property goals like these people, like what's something that they should consider in this situation?
They need to consider the long-term aspect of their employment firstly. What do they want to achieve? They want to buy a property, but at the same time, they need the security as well of income. They're consistently living there. Now, that's one of the questions that the person needs to ask themselves, is that, am I willing to take that risk of potentially looking for employment closer to the time where I need to change employment? And so, therefore, they may decide, well, that may be too much of a risk for me.
These are the kinds of questions like that people are asking every day online. And it's so, I'm so thankful that you break it down for, these scenarios, because they're very broad, they're very real. And I want to leave our listeners, because we're coming to the end of our time today, Daniel. This is fun for me. So,
I know, it's gone very quickly.
I know, I'm like, shit, there's so many things I haven't asked. And I just, want to leave listeners with something practical they can act on. I think the overall vibe is, definitely have a chat. But what's one piece of advice you'd give to someone in their own growth phase? Like, that they're in?
Because a lot of people don't necessarily read the fine print. They don't do the research. They don't speak to the people that they need to speak to. And if they want to get into that growth phase, know that it's going to take a lot of sacrifice. There's going to be a lot of dedication that's required. There's going to be a lot of things that need to be thought out to get to that level. You've got to be willing to just put in the work. At the end of the day, once you do it, there's a satisfaction to it. So just keep at it, keep sticking to it, and you'll eventually receive the benefits of those sacrifices.
I love that. What a great way to end this episode, and that's a solid message to our listeners, Fruits of the labour, what is it that they say? It's like fruits of the labour, work bloody hard.
Exactly.
Yeah, it's starting up or in the growth phase is tough for anyone, whether that's on personal life or on financial level or business level. Talking to someone like Daniel is going to get you on the right structure from day one. And if you're doing it not at day one and there's someone listening going, shit, I've got bad structures in place, I probably should have spoken to Daniel about 5 years ago, or you're in that growth phase and you're like, I don't know if I can do this. Just remember, this episode is exactly why you need to reach out to, Daniel as a professional, someone to actually bounce these ideas off and set you up properly. You don't need to suffer in silence. You don't need to be drinking your lattes at time like I was and thinking that this is a good idea and then wondering why you can't. These are small things, small adjustments, small habits and sacrifice. It'll be the ultimate payoff at the end. So, Daniel, thank you so much for being on the show today, and thanks for uniting with me. Oh, of course. It was like I couldn't dream of anyone else. And when we caught up, I was like 100%.
Yeah, absolutely.
And after 2 hours, our 6 topics covered.
Yes.
I think we did a really good one.
We've got more to figure out.
Oh, we're going to be together.
Yeah, we will.
Yeah, it's like I've got our producer and marketing just sitting here and they're going to go, do you be here forever?
It can be for another day, maybe.
Yeah, but maybe.
But no, thank you so much again for being here. And thank you to our listeners for tuning in today. All of Daniel's details will be in the show notes, of course. And as I always say, a call costs nothing. Pick up the phone, book a call and have the conversation and find out what your options are. The worst thing that can happen is you find out what you're doing wrong and maybe you've got a pathway forward. And we're not done yet. Like I said, we are actually having Daniel back in a future episode where we'll unpack even more. So make sure you drop us your feedback on this episode and let us know what topics you want us to cover on our next one. That's it for today's episode of the No BS Real Estate Podcast. If you found this helpful, share it with a mate who's in business or building their property portfolio, and we'll see you next time. Thanks everyone for tuning in, and thanks, Daniel.
Thanks, guys. Thanks, everyone.
That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodey AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodey.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodey AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodey.com.au or send us a message. We'd love to hear from you. Thanks for tuning in, and we'll catch you in the next episode.